Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are cracking open one of the most debated names in all of pharma right now, Pfizer, ticker PFE. Lana, this one's got a lot going on.
It does. Pfizer saved the world from COVID, and now investors are asking, what's the encore? The stock is down more than 55% from its pandemic highs, sitting at about $27 a share with a 6.2% dividend yield. This is either a deep value play or a value trap. Let's find out.
Let's start at the top. Pfizer was founded in 1849, that's 177 years ago, by cousins Charles Pfizer and Charles Earhart in Brooklyn, New York. Today it's headquartered in Manhattan, employs about 88,000 people across 80 countries, and operates across oncology, vaccines, primary care, and specialty care.
And the business model is classic big pharma. Discover drugs, develop them through clinical trials, get FDA approval, manufacture at global scale, and sell them through a massive commercial infrastructure. What makes Pfizer different right now is the sheer magnitude of its portfolio transformation.
Right, because 2 years ago, Pfizer bet the entire post-COVID war chest on cancer. The $43 billion Seagen acquisition in December 2023 was the largest pharma deal in years. It doubled Pfizer's oncology pipeline to 60 programs overnight.
And that's the central thesis here. Pfizer went from a company where COVID vaccines and Paxlovid drove nearly half of revenue to one where oncology, led by antibody-drug conjugates from Seagen, is supposed to be the next growth engine.
The man behind this transformation is CEO Albert Bourla. Greek-born veterinarian, PhD in biotechnology, joined Pfizer in 1993. He held senior roles in 5 countries before becoming CEO in January 2019. And then, COVID happened.
Bourla became a household name, leading the development of the first authorized mRNA vaccine in under a year. That was the moonshot. Now comes the harder part, proving that the Seagen bet and a new obesity pipeline can rebuild Pfizer's growth story. He told Fortune earlier this year, "We saved the world from COVID, now we'll save the world from cancer." That's the ambition.
Big words. Let's see if the numbers back it up. Lana, take us through the financials.
Starting with valuation. Pfizer trades at 19.8 times trailing earnings. But that number is misleading because GAAP earnings include significant one-time charges from the Seagen integration. The forward PE of 9.2 times is far more relevant. That is dirt cheap for big pharma.
For context, Johnson & Johnson trades at 21.6 times, Merck at 15.9, and Eli Lilly is up at 43 times. So Pfizer is the bargain bin of the group.
Price to book is just 1.65 times, EV/EBITDA is 12.1 times, and the price to sales ratio of 2.5 times is the lowest among its major peers. The market is pricing Pfizer as though its best days are behind it.
Okay, so it's cheap, but cheap for a reason, right?
Let's look at income and growth. Full year 2025 revenue came in at $62.6 billion, down 2% year over year. That's a sharp contrast to the COVID peak of over $100 billion in 2022. Adjusted EPS was $3.22, up 3.5% from 3.11 the prior year. So earnings are stabilizing even as revenue declines.
And the quarterly trend actually looks encouraging.
It does. Q1 2025 was $14.5 billion, Q2 was $14.9, Q3 was $15.7, and Q4 came in at $17.56 billion, beating estimates by over $900 million. That sequential acceleration matters. It suggests the base business is gaining momentum even as COVID products fade.
What about margins?
Gross margin is 74.3%, strong for any company, excellent for pharma. Operating margin is 21.9%, which is below peers like Lilly at 44.9% and AbbVie at 38.3%. But there's context. Pfizer is absorbing massive Seagen integration costs and running the largest cost-cutting program in its history. $4.5 billion in savings targeted through the Pfizer Manufacturing Optimization Program.
So margins should improve as those costs roll off.
That's the thesis, yes. Now cash flow. Free cash flow was up $10.4 billion in 2025, giving Pfizer an FCF yield of 6.8%. That's actually quite strong, and it's the number that dividend investors should focus on.
Because the dividend question is the elephant in the room.
It is. Pfizer pays $1.68 per share annually, yielding 6.24%. The GAAP payout ratio is 125%, meaning Pfizer is technically paying out more in dividends than it earns. But the free cash flow payout ratio is 93.3%. The dividend is covered by cash flow, but barely. There is no margin for error.
So the dividend is safe for now, but it's on a tightrope.
Exactly. The 5-year dividend growth rate is just 2.5% annually. Pfizer has increased its dividend for 15 consecutive years, but further increases will depend entirely on whether the pipeline delivers revenue growth to offset the patent cliff.
Let's talk balance sheet.
This is where it gets heavy. Total debt is $61.6 billion, driven by the Seagen acquisition financing. Net debt is $60.5 billion, since Pfizer has only about $1.1 billion in cash. Debt to EBITDA is 3.5 times, which is elevated. The current ratio is 1.17, which is adequate but not comfortable.
Compare that to the peers.
Johnson & Johnson has total debt of $39.4 billion, with nearly $20 billion in cash. AbbVie actually has more debt at $67 billion from Allergan, but generates stronger free cash flow. Pfizer's balance sheet is workable, but it constrains the company's ability to do more large M&A until it deleverages.
So bottom line on financial health.
Overall, Pfizer's financial health is watchful. Strong free cash flow and gross margins support the dividend today, but the combination of declining revenue, a massive debt load, and an approaching patent cliff means execution on the pipeline is not optional. It's existential.
Watchful. That's a fair call. All right, let's check in on what Wall Street thinks. Analyst consensus on Pfizer is a hold, with 13 analysts covering the stock. The average price target is $28.23, which implies just about 5% upside from here.
The range is wide, though. The low target is $25 from Barclays, with an underweight rating. They're focused on the patent cliff. The high is $36 from Goldman Sachs, who sees upside from oncology pipeline optionality. Morgan Stanley just raised their target to 28, with an equal weight rating on April 10th.
So nobody is pounding the table here.
No, and the recent earnings results were actually solid. Q4 2025 EPS of 66 cents beat estimates of 57 cents, a 16% beat. Revenue of $17.6 billion topped the $16.5 billion consensus by 5.5%. But the 2026 guidance disappointed. Revenue of $59.5 to $62.5 billion and adjusted EPS of 2.880 to 3.10. The midpoint missed analyst estimates by about 2.4%.
What about insider activity?
Net insider selling has dominated. SVP and Controller Jennifer D'Amico sold shares in March 2025. There was one notable insider purchase. Board member Ronald Blaylock bought shares in February 2025, but that's one of the very few insider buys in recent memory. The pattern reflects management caution during the transition.
And on the options side?
Put-call ratio is 0.77, which leans mildly bullish. Implied volatility sits in the lower quartile at about the 25th percentile. The market isn't pricing in big surprises. Call open interest clusters at the $28, $30, and $32 strikes, while put protection concentrates at $24 to $26. Options traders see a narrow range.
All right, let's get to the fun part, the bull and bear case. I'll start with the bull case. Number one, the Seagen oncology pipeline is entering what Borla calls a catalyst-rich year. 20 pivotal study starts in 2026. Padcev is expanding into muscle-invasive bladder cancer. Elrexfio is moving to frontline multiple myeloma. These are large addressable markets.
And the antibody-drug conjugate platform from Seagen gives Pfizer a differentiated technology. ADCs are one of the fastest-growing modalities in oncology, targeted chemotherapy with fewer side effects. If even a handful of these programs hit, the revenue contribution could be substantial.
Number two, the obesity play. Pfizer acquired Metsera and is projecting up to 10 phase 3 obesity trials in 2026. Borla went on Bloomberg and said Pfizer is looking for superior results from its GLP-1 programs. Late to the party, yes, but Pfizer has the commercial infrastructure to compete.
And the obesity market is projected to exceed $100 billion annually by 2030. Even a 5 to 10% market share would be transformative for Pfizer.
Number three, the cost-cutting program. $4.5 billion in targeted savings through the Pfizer Manufacturing Optimization Program is already showing up in improving margins. And the MFN deal with the Trump administration removes the tariff overhang that clouded 2025.
And don't forget Vyndaqel. Pfizer's transthyretin amyloid cardiomyopathy drug is already a multi-billion-dollar franchise with expanding indications. It's a growth driver that gets overshadowed by the COVID narrative.
Now the bear case. Lana, what keeps you up at night?
Number 1. The patent cliff. Eliquis, Ibrance, and Xtandi are collectively facing loss of exclusivity from 2026 through 2028. That's an estimated $17 to $18 billion in at-risk revenue. The headwind is $1.5 billion in 2026, rising to $4.5 billion in 2027. That is a wall of generic competition coming straight at Pfizer.
And unlike AbbVie, which had Skyrizi and Rinvoq already ramping before Humira went off patent, Pfizer's replacement revenue from Seagen is still mostly in clinical trials.
Exactly. Number 2. The debt, $61.6 billion in long-term debt at 3.5 times debt to EBITDA limits Pfizer's flexibility. If the pipeline stumbles, the company can't simply go buy its way out of trouble again.
Number 3. The dividend is under pressure. If free cash flow dips even modestly, that 93% FCF payout ratio crosses into unsustainable territory. A dividend cut would be devastating for the income-focused investor base that's holding this stock.
Number 4. The GLP-1 race. Pfizer is entering a market where Eli Lilly's Mounjaro and Novo Nordisk's Wegovy have multi-year head starts and billions in manufacturing investment. Phase 3 data is needed just to prove Pfizer belongs in the conversation. That's not a sure thing.
And number 5, the IRA. Medicare drug price negotiations are targeting some of Pfizer's biggest drugs, and COVID product revenue is guided to decline another $1.5 billion this year. Near-term EPS headwinds are real.
All of which is why the market has this stock at a single-digit forward PE. The bears have legitimate concerns.
Let's do the peer comparison. Pfizer at 9.2 times forward earnings and a 6.24% yield versus the group. Johnson & Johnson trades at 21.6 times trailing, 2.8% yield. Bigger, more diversified, navigating its own Stelara patent cliff and talc litigation, but much higher quality balance sheet.
Merck at 15.9 times trailing, 3.6% yield. Also facing a patent cliff, Keytruda in 2028, but has 80 phase 3 trials in the pipeline and higher operating margins. Merck is the closest comp to Pfizer's situation, but the market gives it a premium because Keytruda's replacement cycle is further along.
Eli Lilly at 43 times trailing, 0.67% yield, growing at 42% annually on the GLP-1 revolution. Completely different animal. Lilly represents what Pfizer wishes it could become in obesity.
And AbbVie at 15.7 times forward, 3% yield. AbbVie is arguably the best roadmap for Pfizer. It successfully navigated the Humira patent cliff by having Skyrizi and Rinvoq ready to absorb the blow. If Pfizer can execute a similar playbook with its Seagen assets, the stock could re-rate significantly. But that's a big if.
So the bottom line, Pfizer at $27 is priced for disappointment. The forward PE of 9.2 times and 6.2% yield tell you the market has essentially given up on the growth story. The question is whether the market is right, or whether the Seagen oncology pipeline, the obesity push, and the cost cuts can collectively rebuild the narrative over the next 2 to 3 years.
The single most important number for investors to watch is Pfizer's non-COVID, non-Paxlovid operational revenue growth. If the base business can grow 5% or more annually, driven by Padcev, Vyndaqel, and new launches, then the patent cliff becomes manageable and the dividend is safe. If it can't, the stock stays stuck.
And we'll leave it there. Today's closing quote comes from Peter Drucker, who said, "The best way to predict the future is to create it."
Which is exactly what Borla is trying to do. Create a future where Pfizer is known for cancer drugs and obesity treatments, not just the COVID vaccine. Whether the market believes him is the $153 billion question.
That's our deep dive on Pfizer, ticker PFE. Facts first, always. If you learned something, share the show with a friend who's staring at that 6% yield and wondering whether to pull the trigger.
And remember, we present the data both sides. You make the call.
This is Charged Alpha, the S&P 500 stock encyclopedia.
See you next time.
Disclaimer: this podcast is for informational and educational purposes only. Nothing discussed constitutes investment advice, a recommendation, or a solicitation to buy or sell any security. Always do your own research and consult a licensed financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.